Welcome back, everyone. Today we're going through Cairn Homes, an Irish home builder that was suggested in the comments section, and after having a look into them, they are a really tasty dividend-paying stock. So let's get right into it. Ticker symbol is CRN on the London Stock Exchange. They currently trade at a price of 92 pence, and they're down about 10% over the last 12 months. If you hear a bit of a break in my voice, been ill the last while, so just to explain that there, but market cap 633 million, so they're not a little fish by any means. Now, they're actually up 4% in the last 7 days, mainly because their dividend just went ex today, the 20th of April. Oh no, it goes ex tomorrow, so you would have needed to have bought it today, as the way dividends work. Okay, let's dive into them, see some of their good points. This is their snowflake on Simply Wall Street. They score a 6 out of 6 in valuation. Quite rare you see that. Alongside a flawless balance sheet. Now, flawless, we'll have we dive into that. Dividend scores a decent 4 out of 6. Future is 2 out of 6. They're a wee bit uncertain with a lot of home builders. You'll see that across the board for a lot of analysts. And past performance is 5 out of 6. So we'll go through all the checks, see all the good things going for the company, and see if we can spot anything that we might need to keep note of. Trading at 33% below their fair value. This is based on a discounted cash flow model that Simply Wall Street uses. Earnings are forecasted to grow 7.53% per year, and the earnings grew 87.4% over the past year. Now, the explosive amount of earnings is a lot of companies coming out of the pandemic, getting back to work, and recouping some of their more dormant business since the pandemic. Trading at a good value compared to peers and industry, and analysts are in good agreement it'll rise by about 48.5%. Unstable dividend track record, we'll be looking at that later on. So, in terms of competitors, this is some of the automatically generated ones. I actually went in, edited them to some more familiar names in the housing industry, maybe a wee bit bigger in market cap size, but you could use these if you wanted. Okay, over the last year, we can see that there's not been a massive amount going on. There's a few executive board changes, earnings updates, but their dividend did increase. Now, you can click in and read as much as you want. They authorised a buyback plan, for example, on the 2nd of March there, a wee while back. And if we want to bring it out the last 3 years, we can see where they dropped back in 2020. Actually, we'll have to bring it out to 5 years. Yeah, they were trading at about £1.10 come March when the global pandemic hit, and it dropped to about 63 pence. Now, they have since recovered, and it seems to be on average £1 is sort of £1.10 seems to be the higher ceiling point for them, at least in the last 5 years. So trading at 90p, they are certainly a bit below that. Now, if we move on, in terms of good news, a co-founder recently bought some £91,000 worth of stock. That's certainly a good sign, especially from someone on the board as high as a co-founder. Price volatility, that's providing the co-founder is on the board. We'll see that later on anyway. Shareholder returns for the industry. You can see that Cairn Homes has performed slightly better than the consumer durables, and a wee bit better than the market itself. It's a relatively low volatility. It's sitting at about 4% average weekly movements. About the company, it was founded in 2014, so it is a relatively new company by all standards. 321 employees. Michael Stanley is current CEO. They operate as home builder in Ireland and involved in the development and sale of residential properties as well as rental properties. Incorporated in 2014, based in Dublin, Ireland. Earnings 71.49 million, revenue 544.7 million, giving them a PE ratio of 8.9. Now, this doesn't mean all that much until we look at their peers, so we'll certainly go down, have we look at them in a second. Now, what's very important here, this is their earnings and revenue. So cost of revenue was €483 million. Sometimes it will jump between pounds sterling and euros, so do keep an eye out on that. Gross profit was 134 million. We can see that meant that it was 21.74% margin. Their other expenses, 53 million, leaving them a net profit margin of 13.13%. Debt equity ratio's relatively low at 22.7%. That's always good to see. Their next earnings update is the 7th of September, their last one there being December 2022. Now, in terms of dividend, their yield is 5.9%, very modest at a 53% payout. Again, all good signs when it comes to that. Ex-dividend date was the 19th, so you would have needed to have bought the share today in order to get the dividend tomorrow. Although if you're seeing this share or this much later on, the next date will probably be, we'll see later on what way they pay. It's probably every 6 months, I would imagine, for this company. Dividend pay date then is the 16th of May. So if you have any shares, well, that'll be a good day for you, certainly. Down to valuation, where they scored 6 out of 6. So you can see price to earnings versus peers, industry and fair ratio, all good. Below fair value, significantly below fair value, and the analyst forecast were they were pretty much in sync, which is quite rare to see at times. Now, when it comes to their price to earnings versus peers, I simply edited on Simply Wall Street. You can do this. Just go in. You can edit all the peers. To maybe a more familiar company that you want to see them against. I put them against Bharat Developments, Persimmon, and Taylor Wimpey, a few, and Redrow, some companies that I was more familiar with in the industry. Now, they are slightly higher in the price to earnings ratio versus some of their peers, but all being said, they're much lower when it comes to an industry average, sitting quite low there alongside Bharat and Redrow. Now, when it comes to their price to earnings versus a fair pay ratio, they reckon a fair one for this company would be 12.4 times. So again, going well in their favour. Now, when it comes to a discounted cash flow model, Simply Wall Street puts them at a 33% undervaluation. Fair value would be £1.38. Now, we do know that in the last 5 years, they were at least somewhat close to that before the pandemic. So it's not out of the realm of possibility to say that even though a pound was a sort of good average for them over the last couple of years, or the upper end of the average anyway, at 92 pence, it probably is a wee bit of an undervaluation. Again, this is a model, so don't take it as absolute, but something to certainly keep in mind. Let's go down to future growth. Now, they scored 2 out of 6 for this one. 7.5% earnings growth rate and an earnings per share of 11.8. Now, if we look at the forecast table here, we can see over COVID, they certainly dipped quite a bit in both revenue and earnings, but they didn't go into the negatives, and they have crawled their way back. Well, I say crawled, they have stormed all the way up to earnings of 81 million that you've seen earlier. Analysts are forecasting that they are continued to grow into the future, which would be very good for not only their stock, but their dividend as well. Throwing in free cash flow, it appears that they also have quite a bit of that as well, evident through the buyback that they were doing earlier in March. Now, let's jump just down to past performance here. 5 out of 6, quality earnings, growing profit margin, earnings trend, accelerating growth, and earnings versus industry. Now, they don't have a high return on equity, but we can look past that on this one for now. Although if it is a factor for you, always consider it. A lot of people, when looking through stocks, they look at certain things. Some people just want a consistent dividend. Maybe it's high, maybe, as long as it's consistent. Some people like to see a good balance sheet, good past results. It's all different, but I always recommend that if you're using a website such as Simply Wall Street, that you can find in the description with my link, absolute shameless plug there, you can have a wee look through it yourself. At 25.5% historical annual earnings growth, they were doing extremely well all the way from 2016 up to 2019. I would say they would have probably continued hadn't it been for the global pandemic. So Yeah, when we throw in operating expenses, they have increased, of course, given the economic climate, materials, labour, everything is up, including inflation as well, eating away. So that's not a surprise to see an increase in operating expenses. Not massive, but it is something to certainly look out for in their next earnings update. Down to their financial health, they score 6 out of 6 here with a 22.7% debt equity ratio. That's pretty good. Interest coverage of 11.7 times. Again, pretty good. Cash on hand, €21 million, but they have 751 million in equity, 273 million in liabilities, and over 1 billion in total assets. Now, we can see here that is massive. Now, long term, not as great, but that being said, their short-term assets seems to cover both long-term and short-term liabilities. Their debt-equity ratio here, you can see they've actually been lowering their debt over the past while. If we throw in cash and equivalents, they used to have a wee bit more cash on hand, but again, it's not a massive put off seeing this, because 22.7% debt equity ratio is pretty promising. Now, when it comes to their debt coverage, operating cash flow sits at 54.9%, and again, interest payments well covered on earnings before tax. Interest and tax at 11.7 times. We make up of their balance sheet, an awful lot is made up in inventory. I wonder how that's put across. You can use other websites like Alpha Spread, for example, that always have in the description to have a wee different look at the makeup of their balance sheet. Right, down to the main event, dividend, 4 out of 6. Now, 5.9% dividend yield is definitely a massive plus. Pay ratio of 53% again is quite low. The industry average yield is 5.3%, and as you know, their ex-dividend date was it is tomorrow, but you would have needed to bought shares today on the 19th of April 2023. Now, the dividend yields forecast in the next 3 years to actually grow to a massive 10.5%. Now, if that is true at the current value, it is extremely underrated. Will it go there? That is one of the major questions. Could it be a good part of a portfolio to round out a up-and-coming home builder? Perhaps. Now, let's see. Of course, none of this is financial advice, just my speculation. Now, when it comes to dividend yield and dividend per share, the dividend per share has been growing quite steadily. They did pay it in 2019. I actually believe that was one of their first payments. Unfortunately, COVID, they cut it for the next 2 years. Coming back in 2021 at 4.8% and continuing to grow. You can see on the current trend, though, they're looking at basically doubling their dividend per share. Of course, if they end up doing that, I would imagine their share price would continue to rise along with it. Not resulting probably as high a yield, but the dividend per share doubling is by 2024 is promising, to say the least. Earnings per share is also set to increase. It's nearly doubled in the last 2 years as well. Now, is it stable? Well, they haven't paid for the last 10 years. You know, a lot of metrics like to see a company pay for 10 years to consider it a stable dividend. And it hasn't been paying a growing dividend for the last 4 years. Now, in the next 2, that may change. But these are all things to certainly consider. Cash payout is just slightly lower than earnings payout at 49%, which is also very good, meaning they have a lot of cash flow retained for other things. When it comes to their management, we were talking about Michael Stanley there. He gets about 1.1 million euros a year and 8.4 years in the job. Let's see, you can find out a wee bit of information on Michael here. He serves as the CEO of Cairn Homes since 2015. He was an executive director from 2014. He has a strong pedigree in home and property development, and he served on Stanley Holdings from 05 to 07, following the demerger of Shannon Homes. I actually remember that name in 05. He co-founded Coastland Partnership in 01 and served there until 09, so he's in certainly a lot of companies revolving around home and property development. Now, As a CEO, you can see that total compensations remained relatively high, and company earnings have steadily increased under his leadership. Now, when it comes to the leadership team, they are pretty average tenures, about 3 years, so that's considered experienced enough. Board members average tenures 8 years, so that is definitely a massive leap, which is always good to see. They must have a lot of trust and in the company, and have worked well there. So we'll see. Ownership, Michael Stanley actually has 3.17%, whilst the co-founder Alan McIntosh has 4.4%. So about 7-8% between the two co-founders. That's always nice to see. That means that they have a lot of belief in their own company. As I say that, I noticed Alan McIntosh sold 8 million in the 10th of November last year. Michael picked up some back in March. So that's certainly something to note. Even though he did sell 8 million, he still holds about 4.4%. So it didn't take the biggest dent out of his ownership. Now, let's see a breakdown. I always love to see this. Institutions, general public, hedge funds, and individual insiders. So that's them two at 7.7%. Quite a large portion is general public, but 56% institutions. I'm going to take a good guess that, wow, that is surprising. Lansdowne Partners Limited and Fidelity International are the top two, followed by FMR and Columbia Management. T. Rowe Price Group makes a wee appearance here in fifth. And then there's Alan and Michael. Very surprising. I do not see Vanguard or BlackRock. That's unusual. Normally you see them near the top of nearly any company. So yeah, that is one for the history books and me looking through companies at the moment. Speaking of T. Rowe, actually, T. Rowe Price Group, we will be looking at them next. They're an investment management company that also pays a dividend, US based. So we look at that and see how they're performing. But let me know if Cairn Homes is part of your portfolio. What do you think of the company? And do you have any other suggestions? Let me know in the comments below and we'll have a wee look. So thank you for watching. See you in the next one. Bye bye.